Okay, Cisco. Cisco is quite, let's say, old company if we look at tech companies. It was established in 1984 by Leonard Bosak and Sandra Lerner. Before 1990, it was in private hands, and after that, it went public. Okay. In 2020, so this specific year, Fortune magazine ranked Cisco at number 4 on their annual list of 100 best companies to work for. Okay, on employee service satisfaction, which is pretty good, right? And 40% of their revenue comes from outside of United States. And for us, it's also pretty good thing to know, because if there is a recession in one particular country, the company can generate money from other countries. Of course, this pandemic affected every company, every country in the world, like in the majority of cases, but we don't know in what extent the affection is going to happen. All right, and but in any way, so the companies which operate on a global level, they are more stable in majority of cases than companies which kind of serve only one market. Okay, in this particular case. Now, if you go to website, if you type just cisco.com, and by the way, if you type from Australia, you have to choose the global market. Otherwise, you will see only the products which are available in Australia. But if you go to global website and go to products, that's what you will see on the left-hand side. And then you can go and check what kind of products they have. And I just had certain screenshots just to show you in what sectors they work. So for example, networking, okay, and whatever products they have. Guys, honestly, I'm not IT person, and some of these words, they even don't make any sense for me. And I presume Cisco understands that, and look how good they are. For instance, that's the products they have, but then they see for people like me, they say, I need two, and they reduce noise and increase performance with something, right? So I can actually put my problem there, and then they will lead me to the product, okay? And then they show the top product in this category, right? And security, and again, it goes whatever is included there. Then networking, it's called Internet of Things networking. Then indoor access points, then security, collaboration, data centers, cloud. And they have quite multiple amount of products in each sector. So as you can see, Cisco is not only equipment company, they also have software and also have some communication and collaboration, conferencing abilities. So they provide some services as well, which is, and cloud services as well, data centers, which is kind of good because it's not sitting, like it's not chair with one leg, it's chair with four, maybe even 1, 2, 3, 4, 5, 8 legs, right? So which is more stable in this current situation, like a pandemic. All right, so let's have a look at Value Line reports. And for those guys who don't know, Value Line is a company which provides information for financial information for probably about 6,000 companies, US companies. And this company Value Line exists from 1921. So it's practically 100 years old. And their main goal is provide unbiased factual information. So it's not a propaganda of these specific businesses. It's an analytical company. Okay, they charge people money, investors like me, for providing this unbiased information. Okay, this is very important. Now, let's have a look. So what we can see, the report was done September 11th. It means only a few days ago, last week. So quite fresh. At that time, the price was $42. At the moment, it's priced like at least last price after the market close, it was about $40, a bit higher. We can see the price in race is 13, and the dividend yield is 3.5%. So, okay, if you're long-term investors, for you, it's probably good to know that if you put the money, you're going to get 3.5% in US dollars as dividends. Of course, you would have to pay tax on that, but it's another matter. Now, then we have certain parameters here. Timeliness is 2. It means that Value Line believes that this particular company has a quite good chance of growing in price within the next 12 months. Safety is 1. It's the highest Okay, out of 5 they have 1, 2, 3, 4, 5, so 1 is the highest. Technical, so it's kind of middle tree, and beta is 0.95. It means the volatility of this particular stock is lower than in the market. It means that if the market grows up fast, Cisco is going to grow a bit slower. So then when the market drops down, Cisco is going to go down a bit slower, which is good for us right now when the market especially is so high. Okay, we would love to have companies which are not as volatile as index, and especially if the index collapses and like within next month, so Cisco won't go as much as index itself. Then the value line has two types of projections for 18 months and 3.5 years. So 18 months, they believe that the price will fluctuate between $39 and $81. And as I said already, the current price is $40. So it means the risk based on value line is only $1, and the potential is nearly 100%. Okay, if we look at the 3-year projection, 5-year projection, they believe that within that period of time, the Cisco can go, and interesting enough, the price is lower here, right, between $60 and $70, which represent the growth from 12 to 16% annually. Okay, which is also quite good. Now, of course, we have to look at the history, and we are going to do now our own projections. It's good to know what value line thinks, but also we need to calculate in our own way. Okay, so let's have a look now at financial performance of this company. Now, first of all, I'm going to look at revenue. Revenue, you can see the first line here. It's how much product is sold for one specific share. So if you own one share, it means that in 2019, they sold $12.21 of all the services to progress for one specific share. What they do, they look at whole amount of sales and they divide by amount of shares, and this number came out. If you want to know how much they sold for whole company, you go a bit lower and you can see revenue here, $51.904 billion here. Okay, that would be about lower in the second half of this particular spreadsheet. So you can go and look at them both lines, revenue as a whole or revenue per share. I'm going to look at revenue per share because sometimes it's easier just to understand because we buy shares. But another thing why I want to look, because I can see here the crisis time, the recession time, 2008, 2009. And for us, it is very important to understand if the company is going through a recession, how they're going to handle it. It's similar situation if you're going to go, for example, into camping trip with one of your friends. You want to know if you get into trouble, is that person going to carry your bag on his shoulders, right? If you broke your leg or something like that, and or is that person going to cause the problems during that, like whatever bushwalk or something like that? And so that's why you're trying to pick the friends if you go for camping, week camping, who can handle it, right? So a similar situation here, and the way you know that is on the past performance. You ask this person, how did you go? Do you have this experience, or did you manage to survive for 1 week of camping? The person say, no, it was terrible. They carry me back on their shoulders and something like that. So you say, look, this time you stay home, right? Similar situation with stock market. You need to look at their performance during the crisis time. And during our master classes for the last already 4 years, we looked at some companies and they behaved really badly during the crisis time. From earnings, they went straight away into negative zone and they were losing quite a lot of money. Right? So let's have a look at Cisco. What happened here? First, we're going to look at revenue, and then we're going to look at third line, which is earnings. This is net profit. That's the number which company makes after paying all the expenses. Now, we see that 2004, $3.3, then 3.9, then 4.7, 5.7, 6.7. So there was a growth in sales until 2008. And then in 2009, we can see the drop. So it's dropped from 6.7 to 6.2 in sales. If you look at this, it's about what, 27 cents, which is less than 5%. Okay. So during the worst crisis, which believed at that time happened, this specific company lost only 7% in their sales level. What happened after that? Instantly the growth, which is was bigger than 2008, and since that company steadily growing. There are a few years where the company had a slight drop, like here, 976 to 963, very, very slight drop, but then it had a good move again up. Now, this year, the bold numbers, it's a projection, it's not actual numbers because 2020 is not over yet. And that's what we can see. They expect the sales level drop from 1221 to 1166. So it's roughly what, 55 cents, correct? And if we calculate 55 cents out of $12, this is less than 5%. So they expect that their sales level is going, because during this pandemic time, is going to be dropped only on 5%, not more than that. Okay, and then we can see flat for 2021, and then they're going to grow until $14.60 within the next 3 to 5 years. That's their projection. Now, if we look at the earnings level, which is more important because it doesn't really matter how much we sell the product, it's more important how much money we put on our pocket, right? This is the thing here. Again, from 2004, we see 76 cents, 87, 89, $1.17, 131. Again, there was a growth until 2008, and then we see the drop from $1.31 to $1.05. So it's 25 cents, 26 cents, and drop roughly close to 20-something% in earnings. So, and as we can see, the price on that particular time went from $24 to $13. So you see the earnings dropped 20%, but the price halved, went from 24 to 13, like practically half, so maybe 90%. And that's what usually happens. At that time, it represented very good opportunity for investors to buy that specific company also. Right? Now let's have a look what happened after that with earnings, but company didn't lose money at that time. It was still making money, right? And we can see that after that, it was steadily growing. Since 2011, it started paying dividends. And during this specific year, that's what we can see. Last year, they had earnings $3.10. This year, 3.21. Next year, they are planning to have flat year, 3.20 as well, same as today, this year. But they're not going to lose money, and they're not going to drop in earnings. The question is for us now, guys, can we trust Cisco with the earnings? Now, if they're telling us we're going to make this amount of money, will they make this amount of money, or will they make less or more? So it is difficult to evaluate if you haven't followed this company for quite a while, unless you read Value Line, because Value Line provides us this information. And they have, you see in the back, okay, you don't have these slides, just a second. You see in the right bottom corner, we can see earnings predictability score. It is 100. Only few companies in Value Line universe have this score. It means that if the company tells us something they're going to make, they usually don't tell you the specific number, they tell you the range between this and this number, right? And but what happens with Cisco, if they tell you, they deliver that. And they're right 100 times out of 100. But they have not experienced lockdowns when offices are closed before. Yes, of course. The thing is that at that time, 2008, we have to understand how they generate money. Olga, very good question in the sense that are they going to lose a lot of revenues or not? Because look, previously, a lot of businesses lost their business. And as a result, they wouldn't buy or wouldn't continue their business with Cisco. Okay, because remember, in 2008, people already had internet, right? And they already had telecommunication equipment, they had phones and etc. So they needed that equipment in any way. And when they lost the business, of course, they stopped buying it from telecommunication industry, like, I mean, from companies included in the industry. Similar situation happens now. The reason is different. At that time, it was like mortgage crisis, prime mortgage crisis, whereas here, pandemic, but businesses still closing, okay? And they don't provide enough, like, I mean, products right now. But again, the good thing about, like, I mean, good thing about current situation that a lot of businesses, they still invest, and especially they invest in the infrastructure of remote employment now. And that requires additional software, additional equipment. And I believe personally that companies will spend this money. At the moment, maybe they are not spending that much because they are not 100% sure if they're going to need it when the pandemic is over. But as soon as they specifically clarify for themselves that that's the way they're going to run business from now on, they're going to put more money into this. And of course, they will go back to those companies which can provide this type of service. Okay, and Cisco is one of them. Okay, and so this is what we see. The company is growing. There were a few years when company didn't have a growth. So for example, here, where did I see it? 2.3, 2.39. Actually, in that perspective, constantly growing. In sales, it was a slight drop here, 979 to 963 in 2016. But the rest of years, there was a growth. All right, so we looked at the earnings perspective. Dividends, constant growth. They increase in the amount of dividends every year, which is fantastic, which is good. It means that company believes in their future. Company is not going to pay off dividends and give the cash out if they believe that there is some difficult situation in the future and they require cash in the future. So this is one thing. So secondly, let's have a look as well for quality perspective. I'm going to show you the amount of debt. Now, if you look at capital structure on the left-hand side, you will see that they have currently $14.6 billion in debt, which is, some people might say, oh my goodness, it's huge. Now, the question which we have to ask, is that debt causing the problem, or is it like normal level of debt for that specific company? So if we look at capitalization of this specific business, it's $1.78 billion. It means that the total debt is actually less than 10%. It's roughly 8%. It's one thing. Secondly, let's have a look at net income. How much money this company is making during 1 year, right? And we can see that during last 2019, they made $13.7 billion. And the total debt is $14.6 billion. It means that if they want, they practically can pay their debt if they use the income, net income, that's the pure cash which they receive within 1 year and practically get rid of the debt completely. And if we'll go a bit high again on the second line in this sheet, we see that cash flow, the actual cash which they receive is a bit higher than net earnings. So that means that they can cover the debt much quicker. And which is, this situation is pretty good because we analyzed two companies and previously, and we saw that the level of debt was quite high. And it caused the problem because people are not 100% sure if the company is going to manage the debt. Are they going to be able to pay the debt or not? Now, this is one thing. Second thing which I want to show you on the left-hand side again, and the slide is going to change now in a second. It seems like you have delay because I have another screen here just to show you. So you can see on the left hand side on the top corner, the current position and current assets, cash assets, $29 billion. So they have cash amounted of $29 billion. So guys, if they want to pay this debt, they can pay this debt instantly, like no questions asked. So they have no problems with that specific. All right, as long as we're on this page, I'm going to show you the growth rate. You can see the second square here. You can see annual rates. Within last 10 years, they were growing in revenue 5.5%. It's an average, and 8% in earnings, so in net profit. So it's good when we see that earnings growing a bit faster than sales, because it means that they are not selling more product with discounts, and sometimes companies, they actually shrinking their net profit. In this particular case, we understand that they are not only growing in sales, but also optimizing their business processes. And now they sell 10% more, but they're making 11 or 12% more profit. I mean, in this particular case, 4% for the last 5 years in sales and 6.5% growth in earnings. And they expect the same type of level of growth, 5% in sales and 7% in earnings. Guys, you probably know that it's not the best level of growth which we can expect. And during not last year, but previous years, every time when I was showing different companies, I tried to find a company with a potential of growth and the past growth more than 10%. That was the ideal situation. But currently, with this pandemic thing, it's very difficult to predict what to expect in the future. So that's why we need to look at kind of assets which can secure our cash and choose companies which definitely not going to lose money during this specific year or next year if this pandemic is going to continue. Okay, and the bigger the company in that industry, the more stable it is. Okay, because they have plenty of cash, they have constant growth, they have different type of level clients, from small clients, small companies, individual clients, and also the corporate clients. Okay, so any type of client. So this is kind of a good thing for us. We can see if we look at quarterly revenue within the last 5 years, they never lost any like revenues and profitability, never had losing quarter, which is fantastic, which is great. Not so many companies, if you go through stock market, can pass it. And you probably already noticed that out of 69 companies which were included in this specific industry, only Cisco has this type of parameters. The rest of companies wouldn't be as good, even close as good to value line. Some of them, they have higher growth rate, but the P ratio and valuation of those companies will be close to what we have with indexes. They would be 30 or more. Okay, and those companies, they have a risk. If something is going to happen with the general market, the prices for those specific companies, they can drop much more. They can go 20, 30, 40% in going down. Okay, David, eager valuation may be a tricky topic. This pandemic reveals businesses that thrive as they see innovation gain even more transaction of difficult time. It is possible that we need evaluation methodology that somehow takes into account a premium that investor should pay for these businesses. I understand you, and you're completely right, David, because it's impossible to evaluate some new businesses. For example, nobody could expect that Zoom is kind of last year. Yes, Zoom existed already for many, many years, right? But only this year it became so actual. And the main reason we are running now all this presentation for Zoom, and of course it's affected the price of this stock, right? And a lot of people enjoy the growth, but probably I looked already at Zoom performance, and their profitability didn't grow as much as the price. So it means that the price started growing much faster than its earnings. So there is a gap here. And when there is a gap like that, so if previously company would say making $1 and people pay for it $10, now it's making $2, but people paying $100 for that. So it's definitely, even the company is fantastic. Yes, the company is growing, but the valuation is too high. If the company managed to sustain that growth rate and start increasing their profitability all the time, like doubling it, that's why people are paying that amount of money. But currently, a lot of people buying Zoom, not because their financial performance is fantastic, because it's like everyone is talking about it, and they believe I have to put money somewhere, and it's not going to be, let's say, Virgin Atlantic. I'm going to move money from Virgin Atlantic. Well, what will I buy? I will buy Zoom, As a result, the price of Zoom just escalated so high. I don't have just in front of me the report, but if you want, David, we can go through our club meetings and I can show it. And you will see that for some companies, which are kind of Facebook, right? Also, they started making more money, but look at their price. It moved much, much more in that. And we have a risk here. So if you lived on that income, for example, if you were providing your family with that particular income, will you risk it? Because if the stock price can go from $300 to $200 and stay there for the next 3-4 years, will you be able to provide your family? So probably not. So that's why most likely you're going to be kind of more careful about what kind of businesses you choose. And one of the valuations is going to be, let's say, price earning ratio. Another, which you can use, it would be price to book ratio. Now, from Cisco perspective, price to book ratio is not that accurate because Cisco has a lot of patents which are not included in book value. They have a lot of rights, which also intangible assets. If you, after that, try to evaluate it, it's quite difficult to evaluate in this particular case. If you go for business like Starbucks, it's very easy to calculate their tangible assets. With Cisco, it's not the case because it's more like software IT provider, right? So another option you can based on the sales level. So if the company sell $1 billion today, that's how much I'm paying. If the company is selling $2 billion next year, that's how much I'm paying. And then you'll see the growth rate. So if one company is selling $1 billion and then $2 billion, it's one price. But if one company sells $1 billion and next year $4 billion, so you understand for the second company, you're going to pay more money. But the question is, the second company, is that company will be able to provide that and sustain that growth rate? Maybe that's it. It's only 1 year and now they're growing. And you have to ask yourself the question, what happens with Zoom if everything goes back into norm? What happens if all businesses opened up, all schools, they start running their classes not online but offline? What happens with Zoom? Will they lose their business? What happens with their revenue? What happens with their net income? We cannot tell that because in majority of cases, you say, okay, I don't need Zoom and I'll subscribe. And their revenue drops quite a lot and their net income drops quite a lot. And people who bought that on a hype, they will lose a lot of money. Okay. So that's why it's very difficult to evaluate company, any type of company, based just pure on finances. You have to understand the business. That's why the first advice which I always give is to go and invest in companies or industries which you understand. And if you're an IT person and you understand this, go and invest in IT industry. If you're a pharmacist or doctor or some kind of related to medicine, go and invest into those fields, because for you it would be easier to understand not only financial performance of those businesses, but also where that business is going to be in the future. Okay. That's how I answer probably this question. And the P ratio for me, it's one of the best valuation because it's easier to understand. If you're making $1, how much I'm paying for this particular profit, $1. And for me, the second question, are you going to sustain the same type of profitability next year? For small companies, for growing companies, it's very difficult to say. Look, for example, Tesla, great idea 10 years ago, they're promising people that they're going to make money next year, but in reality, they just started making money, okay, recently. And a lot of people who had Tesla, they had a lot of stress during that time because sometimes it went all the way up, sometimes it went all the way down, okay, and people experienced that. All right, I don't know, David, if I answered your question on your comment, so put plus or whatever.